Let's turn now to accrued income. Accrued income. One of the reasons I was discouraging you from using the term accruals just on its own is because we might accrue income. We'll see what that means in a moment. We might then be tempted to talk about making an accrual, and to my mind, that's getting dangerously ambiguous, and it would be better to, in this context and all contexts really, just avoid using the word accruals by itself and always spell it out so we know which different kind of accrual we're speaking about. So accruing income. Income is a benefit. It's an expectation of receiving value or a recognition of value received in some form that's worth recognizing for accounting purposes, and it will turn into cash in due course. A few segments back, we were talking about accounting for sales. Let's take a copy of that. So this is a duplicate of our tab for accounting for sales, and this tab will be accounting for accrued income. And accounting for accrued income. Let's remove this label. This is so far just an exact copy of sales, accounting for sales. Let's expand this label. So receivables, assets, receivables, and accrued income. Accrued income in the balance sheet is an asset. And then down to the reconciliation, where we've got increase in receivables. Let's expand that to and accrued income. Copy. Increase or reduction in receivables and accrued income. So this is all true so far for sales. This time it's a modification of sales. So let's say, or receive income in cash, not previously accrued. If we had not accrued income, so we just have a new sale, have a new item of income, and it hadn't previously been recognized, cash goes up, it's a receipt. And in this example, profits are 5, receipts are 5, and there's no difference between the profit of 5 and the cash inflow of 5. Let us say, so it's rather similar to a sale on credit, but this would be recognizing accrued income we've done the work. For that reason, we can include the income in the income statement. The difference is we're going to send a bill for it rather than we have already. So we are expecting to bill the customer, to invoice the customer. We haven't yet, but because we're going to, then we can put an item onto the balance sheet. So our assets on the balance sheet have gone up, reflecting expected future receipts, but there's no receipts yet, so 0 in receipts, but 6 in income. Therefore, profit is greater than the cash inflow. So cash inflow 0, profit 6. Reason for the difference between the profit of 6 and the cash inflow of none is the increase in that asset on the balance sheet, representing the expectation of future receipts from that customer. Next bit, let's say we collect half of the accrued income. By the way, if we invoiced it, then in this aggregated balance sheet, wouldn't see anything changing, but we'd have increased receivables and reduced accrued income. So we just have shifted between those two rows, those two lines in the balance sheet, but they're both the same line. So one asset transforms to another. Let's say we now collect half of this amount. We get a receipt for that half that we've collected. Our cash goes up. There's the receipt. There's the closing cash. The asset that represented the expected future receipt is reduced by that much. That's not income. This income item has already been recognized. So our profit for this period is none. However, we've got a collection of 3, and that's reflected in the reduction here. So this reduced, and we've collected 3. Therefore, we've got a cash inflow of 3 despite no profit. And then this one, let's say we issue credit note for, how to say it? Yeah, I think that works. Issue credit note against invoiced. Let's stop there and I'll pick it up again in the next one.